Hello there. Is it working? Okay, great. Thank you. This is my fourth live stream, and today I'm going to be talking about butterfly networks, which is Longview LGVW that's planning to merge with butterfly networks. And then I'll be also talking about a SPAC that I just bought recently, and the announcement was on December 22nd, and that's Ouster, which is planning to merge with LCA stock. So I'll be talking about those two. I'm pretty excited about the CLA, so if you just stay tuned to the second half of this live stream, I'll be doing a deep dive on them. And I'll be doing a valuation with the other LiDAR company, so make sure you stay tuned for that. Okay, so let's begin. Okay, so disclaimer, before I start, please note this video is for entertainment purpose only, and all opinions are of my own, and it's not financial or investment advice, so please ensure you speak with your financial advisor and consider your risk tolerance before making any financial or investment decisions. Again, these are just my opinion, my 2 cents, not financial advice. So the first one I want to talk about is butterfly networks. I talked about this in my previous stream, how I really like this one. I was very fortunate to get in a small position. I haven't built up my full position yet. I was buying, let's look at the 1 month chart. So I think the announcement was more than a month ago, probably. Yeah, so probably announcement was right here, around right here, and then the stock jumped up to 12.50 that day, and then it went to as high as 17 before falling back to around $15, $14. So I did briefly look at the company. I really liked it. I did some more due diligence. So I really wanted to get in, so I started a position around 15s and I averaged down a little bit into the 14s. So I think my average cost is around 14 or 15. And then it just spiked right up. So I didn't even get a chance to finish building my position. I think if it does come back down to the 17-ish or even 18 or 19, I may, 19 maybe not, maybe 18 and 17s I may be adding to my position. I really like them. So let's look at what they do and why there's such excitement on this company. Okay, so Butterfly Networks, a global leader in democratizing medical imaging, to be listed on the New York Stock Exchange through a merger with Longview Acquisition Corp. Butterfly Networks has a mission is to enable universal access to superior medical imaging, making high-quality ultrasound affordable, easy to use, globally accessible, and intelligently connected. Butterfly IQ is one of their devices, which I'll show you a little bit later, is the only ultrasound transducer that can perform whole body imaging with a single handheld probe using a semiconductor technology. Connected to a mobile phone or tablet, both it supported iOS and Android, and is powered by Butterfly's proprietary ultrasound on chip technology, and harness the advantages of AI to deliver advanced imaging that we believe is easy to use, improves patient outcomes, and lower cost of care. So this is pretty incredible. This sounds already pretty good. Making ultrasound affordable and being able to distribute it to many at low cost to improve patients' outcomes. This transaction is expected to drive further adoption of the Butterfly Network's breakthrough solution and accelerate its future pipeline of innovative technology. So we'll look at that, what the upcoming technologies or products would be in the investor slide deck. The pro forma enterprise value is about $1.5 billion. Remember, this is at $10 per share, so this valuation has significantly increased because we just saw the share price that was trading around $20. With the combined company expected to have estimated $584 million of cash. So if you add that to the enterprise value, you get an equity value of about $2 billion. The founder, Dr. Jonathan Rothberg, is to become the chairman of the combined company and will be Butterfly's largest controlling shareholder. So Jonathan Rothberg, I'll talk a little bit more about him. He sounds very, very intelligent. I've watched some of his interviews, and he definitely won some incredible awards and recognized in the medical field. So I'll talk about him a little bit later. 100% of the equity of the existing Butterfly Network's investors, including Gifford and the Bill and Melinda Gates Foundation, which is incredible, having Bill and Melinda Gates Foundation as part of the investor, and Fosun Industrial Co. Limited will convert into shares of the combined company. There will be no selling stockholders in the transaction, which is good. So I'm not worried about after combining and then people start liquidating their shares. Okay, so it's locked in, looks like a little bit. I don't know the time period, but it seems pretty good. Longview is affiliate of leading healthcare investment firm Glenview Capital Management, which is expected to own, along with its affiliates, 7.6% of the combined company's outstanding shares at closing. The business combination is expected to be completed by the end of the first quarter, so that's end of March 2021, and the combined company will be listed on the New York Stock Exchange under the ticker symbol BFLY. Okay, so let's look at the investor presentation. Okay, let's look at it. Okay. Just disclaimers. Again, here's the Butterfly Networks and the Longview Acquisition Corp's management team, mainly focused on Dr. Jonathan R. Rothberg. He's the founder and chairman of Butterfly Network. We'll talk a little bit more about him. So merger and investment. So the story of Butterfly, they're driven by the vision of an innovative founder, again, Jonathan Rothberg. Butterfly developed and introduced a revolutionary product. So that's their handheld device for ultrasound. Let's go on the website to show you what it looks. Actually, you saw it earlier. This is what it looks like. With a breakthrough technology putting ultrasound on a semiconductor chip, pursuing ambiguity through simplicity and affordability, addressing an unmet need to disrupt a large and expanding total addressable market, align with and enabling healthcare's mega trends, forfeited by an experienced partner, enabling a logical advanced product roadmap, with strong initial market adoption, excitement, and momentum, brought to the public at an attractive valuation. So we'll look at valuation a little bit later. So we talked about a little bit earlier, it's about 1.6 billion, I think, in the enterprise value. We'll look at that further in detail later. Supported by a clear mission and a world-class team. I definitely do agree with this. Okay, here's the transaction overview. Butterfly Network is preparing to go public through a SPAC merger with Longview Acquisition Corp, who may raise additional 175 million PIPE to further support long-term growth. So there's just this option that they are able to raise additional funds. Butterfly Networks is an inventor, pioneer in the emerging field of semiconductor-based point-of-care ultrasound devices and related imaging and workflow software. Founded in 2011 by visionary innovator Jonathan Rothberg. So these are some of the other companies he was associated with and created. Total investment of over 400 million with the first product. So total investment over 400 million. So their valuation was, I think, 1.6 billion. I think that's what it said. Back up here, 1.5 billion, sorry. So putting in 400 million and the valuation as of the transaction date at 1.5 billion, I think it's somewhat reasonable, especially you've put in so much work into creating this product. Less than four times the amount invested. I think it's somewhat reasonable. 700 plus patents in 2020, estimated revenue of 44 million, projected to grow to 138 million in 2022 estimate, which is about 2 years, growing from 44 million to 138 million, which is three times almost, right? So Longview Acquisition Corp is a special purpose acquisition company brought public as an affiliate of Glenview Capital Management. Initially capitalized with 414 million in cash, May 2020, trading under ticker symbol LGVW. Glenview Capital was founded in 2000 by Larry Robbins and is currently in its 20th year of active public markets investing with a focus on healthcare market. Butterfly and Longview signed a letter of intent in October and seek to enter a definitive merger agreement in November 2020. In conjunction with the closing, Longview again may raise additional 175 million of capital through private investment in public equity, PIPE structure, on equivalent terms as Longview's initial investors $10 per Longview share. So I mean, if they need the cash, I think they would be doing this because right now it's trading at $20. The parties seek to again close the merger first quarter of 2021. Here's a transaction overview. I'll talk a little bit more about valuation a little bit later, but so here's the cash held in the trust with a PIPE of 175 million. Estimate transaction fee of 40 million, so it leads to about 549 million of cash added to the balance sheet of the combined company. So $10 per share, pro forma shares outstanding of 203 million, of equity value of 2 billion. You strip out the cash and debt, you get a valuation of approximately 1.5 billion, which is 10.6 times EV to 2022 estimated revenue of 137.9 million. So after the merger, public shareholders will hold of LGVW will own about 20% of the company, and then the existing Butterfly rollover shareholders before will have about 63.5% of the combined company, and then some breakdown between the PIPE and the sponsor and the convert investor shares, 2.5%. Investment case summary: a unique investment and dynamic med tech environment. So here's the investment case per the management. Butterfly attacks a large 8 billion addressable market and expands materially by meaningfully growing each of the following: points of care, geographic reach, and use cases. So we'll see how they're going to grow a little bit later in the investor slide deck in more detail. Butterfly has a very clear right to win. Butterfly is the best product, the best price, and the best platform. They do have some competitors with GE, Philips, and Clarius, which also provide handheld ultrasound devices. So they say that they're the best product. I don't know. I read some reviews. It does seem that Butterfly, if you consider everything, including cost, is one of the better, or I would say maybe better, maybe best product. But there is competition. Butterfly has many attractive investment attributes: strong balance sheet, of course, with the financing, low manufacturing costs, rapid growth, high recurring revenue. This is good. I like high recurring revenue. A discounted relative valuation and high return reinvestment opportunities. At $10, I do agree with this. We'll talk a little bit more about the valuation later. Finally, Butterfly has a strong alignment building clinical and societal value designed for commercial success and shareholder value creation. Here's the vision. So again, Dr. Jonathan Rothberg, as a PhD founder and chairman, has dedicated his career to enabling breakthrough technologies to revolutionize healthcare. So Dr. Jonathan Rothberg invents next generation DNA sequencing and wins Presidential Medal of Tech and Innovation. This is pretty good. I also read some other accomplishments that he has. I think he's pretty well known in the medical field, and he has won several awards. 4 Catalyzer and Butterfly networks are founded. 7 C Corps, 400 plus team members, 750 million raised. Okay. Clinical overview. Addressing the unmet need. Ultrasound usage today has been constrained by high upfront system costs, limited access, and suboptimal convenience. That's somewhat true. A lot of times these are bigger systems and machines, but now that's what they're trying to aim for. So providing medical professionals and patient needs. The affordability, the ease of use, mobility, ubiquity. The opportunity is immense and meaningful. Improving healthcare access and delivery is critical. I talked about this in the NanoX videos. 2/3 of the world has no access to medical imaging, again, per World Health Organization. 2/3 of diagnostic dilemmas can be addressed through simple imaging. A lot of times it really helps improve or save lives where you could detect early through a more simple way of imaging, and this could be it. Of course, I don't think these would replace the bigger machines that are more detailed or perhaps see more clear. These are just more of point of care ultrasound for perhaps less, not as, I'm not sure of the technical terms, but maybe not using it, just using it for emergency and quick use, to guess detect certain things a lot faster than booking ultrasound machine and whatnot at a hospital or a clinic. Use cases: ultrasound safe in a broad applications, again, in the lung, needle-vis, cardiac, bladder, different parts of the body that the ultrasound can be used for. Expanding access to care beyond traditional imaging settings. So the traditional is in hospitals, niche doctor offices, imaging centers, but I think this is where this is the $8 billion global ultrasound market, and $6 billion of it is equipment market, and then $2 billion of it is the services market. And this is the breakdown of the size, I guess, of the ultrasound. So a lot of times it's a cart, about, I don't know how many percent this is pretty significant, but almost 75%. And then this part is the compact, and really the smaller piece of pie right here is less than 3%, which are the handheld devices, what Butterfly is in, along with Philips and GE and Clarius. And their plan is to expand from these main traditional scan settings into further care settings for pre-hospital, urgent care, long-term care, home, dialysis centers, ASCs, veterinary, emerging markets. So I think they're trying to make it more accessible for a lot of different reasons. So I like it. I like what they're doing. And there's an increasing demand for point of care education. With these point of care using these handheld devices, they require some training. These are some of the hours and what they're training for. Technology. So how does it work? There's a powered by ultrasound on chip. So within the device, there's this chip technology, and powered by AI, ultrasound on chip devices, cloud workflow app, tele guidance, augmented reality, user interface, deep learning. So some of the software services include storaging, collaboration, enterprise workflow analytics, telemedicine, educational community. So with the telehealth industry, people are visiting, trying to go to the doctors, I guess, through online rather than going in person, especially with the global health issue right now. There is a need for more of this device, perhaps an individual's home, to help doctors see what the issues are and detect earlier, and not needing to go into the office, or even in the clinic. It could be very useful too when things become back to normal. So I do think there's a increasing need for this type of device. AI, collective intelligence powered by AI, secure clinical data and educational materials, ultrasound on chip platform, 2D, 3D. So here's the products they have. They started in 2018 with the IQ, launched in 2018, and now they have the IQ Plus, which is an enhancement of this IQ. I'll talk a little bit more about this later. Into 2021, they want to bring the IQ in the home, not just the home, but really expanding through those different areas, like long-term care, home, pre-hospital, these different markets. And into 2022, they'll probably come out with a third generation one, probably a more enhanced, longer battery life, more enhanced imaging, etc. And into 2023, here's kind of what's interesting. And on top of the new next generation 4 Pro, they're thinking about wearables in home. So this is what it is. I'm not sure what their plans are. They don't go into detail, but that's where they want to go into. We'll talk a little bit more about that later. Business overview. So they're saying that currently this is the market, and they're hoping to move into nursing and midwives. The 5 million initial target in a 28 million addressable market TAM. They're focused on expansion into new settings. So this is the current settings. They want to move into different areas as discussed earlier. And that's due to like mega trends that because of aging population, chronic diseases, move from hospital to home settings, wellness monitoring, big data are part of some of the tailwinds include big data, AI to empower decisions, value-based care adoption, point of system ultrasound and medical education, new imaging settings. So we talked a bit about this. Again, this as time goes by, this is more the media and this is the longer term to 2024, 2025. They want to get into wearables. They're talking about over 100 million chronic patients in the US alone. And you can't imagine how much globally. So there is demand on the telehealth and wearables and just kind of monitoring, home monitoring segment are growing into the future. Rapid innovations cycle of better clinical outcome. So again, this is the second generation. So it's 15% faster frame rates, 15% smaller, 2 times continuous runtime, 20% longer health. So as they continue to make enhancement to the 3rd generation, 4th generation, I'm pretty sure they're gonna have increased rates, smaller. I don't know if they want anything smaller, but longer battery life, etc. So right now, e-commerce for individual practitioners and early adopters. So mainly general medicine are the people are the groups that are buying it, emergency medicine. So sometimes it's good to have this kind of device. I was listening to some doctors talk about this device on YouTube. And some doctors say it's really useful as a first way to check something or detect something instead of having to move the patient to an ultrasound to get an ultrasound. So having this in the ER is really allows quicker, easy to check for certain things. So that's one of the things that doctors were talking about in those videos. It's very useful. They said it's not meant to replace the more expensive, I guess more clear or more enhancement or more features or functions of machines. More about early detection, a quick use of in general home settings or in clinics, smaller clinics, and etc. Or that can't afford the actual bigger systems. Healthcare institutions to drive adoption at scale. Butterfly has an existing footprint in most of the top 100 US health systems. So a great way for them to distribute their products and grow. Plans to access the home market. We talked a little bit about this, about wearables in 2023. Alternative sites of care. I think they see more a shift from being in the hospital to being at home. So more of these monitoring devices would be required or needed. Okay, so financials. Here's what's really exciting. Butterfly has substantial growth potential across multiple end markets. 65% revenue CAGR from 2019 to 2024. So that's from 44 million, actually before that, to 334 million in 2024. So the near term, again, is really executing pipeline bookings across enterprise and e-commerce markets. And the longer term is the wearables, enabled by continued market penetration and the introduction of wearables. So that's where it comes in, 2023 to 2024. So the IQ is their current device. So they want to scale sales and marketing, execute on enterprise level strategy, further develop software and analytics suite, plans to launch new probe with every technological updates every other year to ensure hardware security. So there are some plans we saw earlier about that. Patch commercial plans, expected commercial launch in 2023, subject to marketing authorization. Patch designed to capitalize on momentum and higher tier software and at-home monitoring trends. Commercialization pursued through payer partnerships as well as direct-to-consumer. So here are some of the revenue expectations or projections. So 44 million in 2020, which is current year, to 334 million in 2024. Gross margins, 43% next year, 51% the year after, 60% the year after, and the 68% in 2024. And this is the year-over-year growth. And the compound annual growth rate, I believe they said was 65% from 2020 to 2024, or 2019 to 2024. IQ versus wearable. Wearables conservatively 0%. So in this projection, they're saying that they did not include any of the wearables in 2022. They estimate 5% of the revenue in 2023 and 10% of the revenue in 2024. The longer gross margin target is 70%. This is pretty good. That's a pretty high gross margin. I think mainly it's also driven by their software as a service recurring revenue that usually has very, very high gross margins. The cash flow target, so they expect to be EBITDA and cash flow turn positive in 2024 and after significant investment phase. Okay, so what are they going to use with their, so what are the compelling investment attributes? Strong balance sheet, I agree. Revenue projected to grow 65%, that's really good. Recurring business software revenue expected to grow to between 40 to 50% of total revenue. So this is what's really driving the gross margins, the recurring software revenue. While Butterfly IQ users are likely to engage in hardware replacement cycle every 3 to 5 years. So they're saying that there's going to be a requirement to replace it every 3 to 5 years, perhaps technological advancements when they come out with these stronger, better devices. Discount to comparables, 10.6 times 2022 revenues with a 70% growth versus comparables at 13 to 20 times. True, this is at $10 though, remember. And so if you're at $20, this is likely to be 21 times 2022 estimates. So this is actually at the high end of the revenues at based on 2022 estimated revenues with meaningfully slower growth. So you could argue that it demands a higher premium because of the faster growth rate. So here it is. Here's the comparison. I like to compare it to disruptive technologies because I do believe the Butterfly is in the disruptive technologies sector. So I think an evaluation of 21 times right now because the stock is currently at $20. And this investment slide deck is based on share at $10. So really it's trading about 21 times. Trading 21 times is comparable to 2022 estimated revenues for disruptive technologies, but it's actually growing at 77% between 2020 to 2022. Meanwhile, disruptive companies are growing at 45%. So I think there's still more room to go, but I'll go back to what I'll be doing and after I go through the slides. There's a few more. I'll tell you what I'll do after going through. I think it's like, yeah, that's the last slide. So again, Dr. Jonathan Rothberg, incredible man. I watched his interview, very smart. I really enjoyed his interviews because he's able to really explain things and really knows what he's doing. He's a recipient of the Presidential Medal of Technology and Innovation for inventing a novel next-generation DNA sequencing method. Previously founded 454 Life Sciences, the company under which he brought his novel genome sequencing method to the market. Founded several additional companies including Ion Torrent, Curagen Corporation, Clarify, Raindance Technologies, AI Therapeutics, Quantum SI, Hyperfine Research, and Forbonics LLC. So pretty smart guy, done a lot of incredible things. So I still continue to believe in him. Backed by Bill and Melinda Gates Foundation. they were valuing the company enterprise value at 1.5 billion, and with 400 million investments, I think that's reasonable. One other thing is ARK invested. Cathie Woods is an incredible investor. Their ARK funds are one of the probably best ETFs out there. And they have one with Geomic Revolution, and in it they actually bought Longview Acquisition Corp. So I'm sure they've done their due diligence, and if they like it, I think it's got to be a good company. Although it's a smaller position, perhaps maybe speculative right now, and plus the merger hasn't gone through. There could be issues with the merger. Perhaps maybe voting doesn't get delayed. Voting gets delayed or something. That happened for a merger was just Tattoo Chef. There was a little bit delayed there. So all in all, what I'll be doing at $20, I won't be adding at $20. Even I really like the company, really like what they're doing, really good growth rates. I think the valuation's reasonable at $20, maybe slightly cheaper because of the higher growth rate compared to the disruptive companies. It came down 8% today. I thought about adding. I'm holding back. I'm not going to chase it. This is what happened. I think Cathie Woods bought on this day, like 21st, and then they just shot up. I thought it might come back down a little bit. I didn't. It just keeps going up, and now it's come back down a little bit. I may add around the $18 level if it gets there. If it doesn't, I have a small position. I'll just keep hanging on to my position. But on any pullback to the 18s, I'd probably be adding and building up my position in Longview. Okay, so before I go to the next one, let me see if there's any comments or questions. Hey, Hallie, hello. Hey, DJ. Hey, Ken Kang. Nice to you guys to meet me. So the next one I'm going to be talking about is quite exciting. I'm quite excited. So the next one is Ouster, which is planning to merge with Ouster, a leading provider in high-performance digital LiDAR sensors, is to combine with Colonnade Acquisition Corp to accelerate digital LiDAR adoption in industrial, smart infrastructure, robotics, and automotive markets. So not just the automotive market, but in different areas, industrial, smart infrastructure, and robotics. So the Ouster's disruptive digital technology delivers superior LiDAR capability to the industrial, infrastructure, automotive, and robotics industries. Transaction proceeds will be used to support the acceleration of the product roadmap, increase in software development investment, and build out the Ouster's worldwide sales and marketing efforts. Transaction is expected to provide up to $300 million in gross proceeds, comprised of from the trust of $200 million and $100 million fully committed PIPE at $10, including from Ouster's existing investors, which is Cox Enterprise, Fontinalis Partners, and WW Junior Enterprises. The pro forma implied enterprise value is $1.6 billion, and fully diluted pro forma equity value is $1.9 billion. Ouster's investors will roll 100% of their equity holdings into the combined company, so that's good. So they're not paying out any investors. Okay, so let's look at the investor presentation. Okay, transaction overview. Business combination between Ouster and Colonnade Acquisition Corp, publicly traded SPAC, CLA. And let's look at the price of that right now. Okay, this was announced on 22nd. Yeah, so you see the huge jump on like a 30-something percent, 38% on the first day. And it went to as high as 16, and then it came back down to $14. Financing. Existing Ouster shareholders will roll entirely of their equity holdings into combined company and are expected to receive 81% of the pro forma equity, which is a little bit high, but it's okay. 200 million CLA cash held in the trust, plus 100 million with PIPE, so approximately 280 million if you less the transaction cost, and I think it says right here there's also 14 million from the Ouster's net cash balance as of November 30th. So approximately 280 million after the combined company. The pro forma enterprise is a 1.6 billion, Fully diluted pro forma equity is 1.9 billion. So we'll talk a little bit more about valuation later, and it's going to be very, very interesting. So make sure you stay till the end for that. Okay, so Ouster investment thesis: strong management team with thought leadership in LiDAR technology. Okay, sure. Significant experience leading both public and private companies. Okay. Software-defined platform expands unit economics with scale. Okay, cool. Software-defined platform. Okay. Gross margin positive today, expanding to be expected to be approximately 60% by 2025. So that's pretty good margins, 60% margins. And we saw earlier Butterfly Networks is about 60%, but they have the software that's really higher margins. So I'll be interested to see how much of the services are as part of their total revenue. Extensive existing customer base, over 450 current customers with little customer concentration. So that's good. Little customer concentration, because if you have a high customer concentration, for example, I think I talked about Fastly, where ByteDance was probably 14% of the revenues, and there were issues with and ByteDance owns TikTok, and there was a whole spiel of like how they're not allowed to operate in the US, etc., and how Oracle came and bought them, where Microsoft was bidding for it as well. So, and then that stock tanked because of that news, because it's so significant as part of the revenue. If you lose a key customer, your revenue is going to be impacted by a lot. So it's good that the customers are not so concentrated. So if you lose one customer, it won't hit your revenue so hard. So they're also saying here, industrial infrastructure robotics customers expected to account for 85% of the 2020 only they're estimating about only 15% of it, the revenues is in automotive. So these other industry will account for 85%. And we'll look at the margins for these, or expected growth rate for these, a little bit later. Breakthrough digital LiDAR technology. Digital LiDAR drives an order of magnitude lower cost. TAM is projected to be 9 billion by 2025 and 50 billion where was I? Sorry. 9 billion by 2025 and 50 billion by 2030. So this is going up 5 times in 5 years. So that's pretty crazy. Across 4 key industries, which they're in industrial, infrastructure, robotics, and automotive. And their implied valuation is 6.2 times EV to EBITDA in 2024. Yes, the stock has gone up to $14, so this is probably 40% higher, but we'll see a comparison between the other LiDAR companies. It's going to be very interesting. The CEO has 15 years of combined experience in LiDAR engineering. He's co-founder, director of engineering, Quant Energy, Bachelor of Science Engineering, Stanford University, bootstrapped Ouster, and Quant Energy proceeds. I didn't do too much research on him. He seems like a smart guy, I guess, for bringing this company to public. Ouster's digital LiDAR technology is disrupting the market. So they're founded around 2015. They came up with this digital LiDAR rather than analog. I'll go through a little bit of that a little bit later. They've have patents granted. They launched. They shipped the first LiDAR, first digital LiDAR point cloud, first generation system digital chip. Launched first shipments in 2018. First bookings of 1 million backlog, 128 sensor chip benchmark facility, 450 customers across 50 countries. Positive gross margin already. Okay, so this is what I really like as well here. 250 plus new customers in 2020. So they had 200 customers before 2020, and now they have 250. So they literally grew more than 100%. And they're expecting 143% of CAGR between 2020 to 2025. This is a pretty incredible growth rate. We said it was good for Butterfly Networks at 65%, but this is growing at 143%. Mind you, these are projections, so I don't know how faithful we are to these projections. They're usually like crazy high. I mean, it'd be interesting to see if they could hit these targets. If they do, it'd be incredible for both of these companies. So these are some of the partners, some of the investors. Cost leadership. So they're saying that there's 100 times part count reduction. So they reduced the number of parts from an analog LiDAR by 100 times. And they're expected to also projected to year over year cost reduction. So they're able to scale and be able to reduce their costs to at a lower cost, so a high gross margin for their devices. We built eyes of the autonomy. We built digital LiDAR. These are the expected units for each of these in 2030, estimated estimates only. So the US, they're expected to ship these many units for the whole US LiDAR market. Okay, low cost, ubiquitous digital LiDAR provider, multi-billion-dollar market, projected cash to reach, so again, 9 billion 2025, 50 billion 2030 across 4 key industries, driven by smart infrastructure, industrial today, auto and robotics projected to explode in 2025. Patented digital LiDAR technology, high performance, low cost solution with 4 new digital LiDAR products launched since 2018. Patented solid state technologies capable of meeting auto and non-auto requirements. Unified hardware diversity through software. Robust developer ecosystem tailored software drives superior solutions for unique needs of the markets. Leveraging differentiated hardware software to move from privileged suppliers to position to direct OEM partnerships. Again, I think we had talked about this earlier. 450 customers, 250 new ones. Here's what's interesting. No customer accounted more than 5% of projected revenue. So that's pretty good. Pretty diverse. Pretty not relying heavily on any customer. Non-automotive customers account for 85% of their projected revenue. So again, that's robotics, smart infrastructure, and industrial. So pretty diverse. Strong financial model, single architecture underpinning all products, streamlines manufacturing and drive scalable production. Expected to drive high gross margins, ramping up 25% plus next year and 60% by 2025. We'll see a little bit more of that later. The jump from analog to digital transforms industries. So they're just comparing cameras, how they were used to be analog, and then it became digital cameras, and just have more expanded multiple uses. Here's an example. So they're saying that most of it's analog until 1999, starting to see more digital. Now digital is dominating. They're saying that's 230 times market expansion. So they're trying to use the same analogy with LiDAR, how it was analog, and now they're having a digital LiDAR that's supposed to go expand the market because several reasons. Here's what they are. Shift to digital drives to step change reduction in cost. So they're saying that there's 100 parts to analog LiDAR, but a digital LiDAR only has 3 integrated technologies, or I don't know if that's really parts, but they're saying that there's the digital receiver, VCSEL laser array, and a micro optics. Basically, they're just saying it's a lot smaller and uses less parts. And driving reduction. I think they use a circuit board or a chip inside this LiDAR. Direct cost of goods sold visibility confirms cost leadership. So they have a visibility of the cost and being able to reduce it, and expected to drop 30% annually with projected volume. Cost of goods sold based on real codes of products in mass production today, driving visible cost leadership today and in the future. This is the order of magnitude of the cost, it looks like. and $100 LiDAR by 2030. This is kind of interesting because I think Velodyne has some LiDAR is around a few $100, so something to take with a grain of salt. Digital LiDAR outpaces others even before they reach the market. Product portfolio. So these are their 4 products that they have. And I guess this is their improvements year over year on their chip. It looks like there's one new one coming out 2021 and probably new ones coming out 2022. And with that digital LiDAR, they're saying that it has significantly increased the performance over time compared to an analog that's kind of linear, and this is exponentially. Okay, so they're backed by a comprehensive suite of patent technology. There's 29 patents granted with 20 different invention families. There's 100 plus applications pending worldwide and covering across 17 countries. So I guess these are some of the technology that they have. Founding technology, digital architecture, data processing. Products built on a highly flexible architecture. So they're saying that they have one common architecture, so that makes it easy to produce and have economies of scale and lowering costs because it's the same kind of architecture across the different devices. Simplified and scalable supply chain, hardware enhancement, and R&D shared across all products. 2 flexible platforms, high perform medical and true solid state technology, high yield manufacturing and simple product mix, single software operating system across all the products. Virtually unlimited software defined customizations. Low cost customization increases SKUs for the industry specific applications. Expanding product offerings requires minimal manufacturing inventory changes. Over-the-air updates enable additional customization. So it sounds like they have a common architecture that can be used and customized for various applications between the different industries, from industrial robotics to automotive and what else am I missing? Industrial. I said that. The other. Smart infrastructure. Yeah. Okay. Simplified hardware. Wide view digital LiDAR, long range digital LiDAR, true solid state digital LiDAR. They built on a single architecture, as mentioned earlier, negligible incremental cost to customize vertical. So yeah, again, they're able to customize on this one architecture, depending on the use. Supported by integrated software. Localization, mapping, feature extraction, object tracking, object classification. So these are not their customers, but these are their target, I guess their targets that could perhaps use their LiDAR technology. So in different various big companies that you could see. Robotics, industrial, smart infrastructure, and automotive. Okay, so here's quite interesting. So here are the different 4 different industries that they're in. The industrial is expected to diversify markets at scale. 40% plus annualized demand growth across markets with smart infrastructure industrial applications leading today. 22% compound annual growth rate for industrial, 51% CAGR for smart infrastructure, robotics 66%, automotive 98%. But do note that yes, it's growing very fast later, like this huge ramp up. At the end of the day, in 2025, it's only 1.9 billion. So these 2 are the bigger markets at the end of 2025. But I mean, if this continues to grow, automotive will be one of their biggest industries. So it'll be quite interesting. So these are pretty good compound annual growth rates. And there are expected margins for each of the industries. And this is, I guess, the projection of how diversified they are. Potential. This is their potential million units, I guess. Highly diversified. Again, they're really stressing about how diversified they are. They have over 450 customers in 2020, and this is the revenue split by the different industries: industrial, smart infrastructure, automotive, and robotics. So it looks like robotics and automotive right now in 2020 is accounting most of the revenues, but they're expecting that these would grow very significantly in the next few years. And here's just some of the applications that it's used. proactive drive, driver safety, mining autonomy, agriculture autonomy, construction autonomy, port automation, robotics, different robotics applications, smart infrastructure, and automotive. Customer forecasts expected to anchor revenue projections through 2025 with $4 billion cumulative opportunity. Just like the projections of how their growth in the next few years. So this is the projections. They're expected to reach about 1.6 billion. Oh. This is. I'll look at their projections later. Okay, so here's an interesting slide also. Ouster well positioned relative to recent LiDAR opportunities. So they're kind of comparing to Velodyne LiDAR, which is a company I've covered in the past. If you haven't had the chance to, their pre-merger ticker was GRAF, GRAF. Lunamar, Aeva, and Innovis Technologies. So they're saying they have unmatched technology, scalability via customization, clear cost advantages. I mean, I think a lot of times companies will, when they're comparing to the competitors, they always make it sound that they're the better one. So take it with a grain of salt. They're saying they have one common architecture with two flexible platforms. We talked about it. High performance mechanical and true solid state technology. Virtually unlimited software-defined customization. I guess their customization seems to rely on software. Low-cost customization enables rapid scaling across industries. Highly scalable manufacturing driven by simplified digital architecture. Strong unit economics rooted in Moore's law. So they're saying less efficient. The auto-first mentality. So Lunamar, Aviva, and Innovis Technologies, they're very concentrated on automotive. Meanwhile, Velodyne is a broad one. So Velodyne and this company is very Ouster is very similar. They're kind of does everything, not just the automotive industry. Assumes high margins in auto, low penetration. Actually, when you look at auto margins, they're actually expecting not that high, 25%, based on their slides, depending upon future market ramp. Okay. Financial overviews. Here's some interesting things. I like talking about the numbers now. Okay, so what does that mean? Diversified revenue base, 450 customers, again, no customer 5%. So these are the same thing. So here's the projections: 34 million, 2019, 19 million. 2020, 19 million, 2021, 34 million. 2022, 104 to 1.5 billion in 2025. These are the units expected that they're going to sell. Compounding growth rate at 218%. So it sounds like they're selling more of a cheaper device in the future. So that's why you have a higher compounding growth rate for your unit sale versus your revenue. Not rely on automotive market. Again, accounts for approximately 15% expected. Gross margin positive today, which is good. Expect to scale. And as they scale, they should be able to have positive or increase their margins from 8% to 59% in 2025. And I think they want 60% going forward. So, I mean, pretty good growth rates, good margins, projected margins. So here it is. So this is their estimate of 1.6 billion. But if they are going to continue to they're expecting that if they could get new customers, expect to 3 times their 2025 estimate opportunity. They're saying that they could go to as high as 6 billion, which is incredible. I mean, I don't know. These are all just projections, but they're saying that it sounds like what they're trying to say is that their estimates are conservative. But I don't know how conservative this is. This looks pretty incredible. So if they could beat this, I mean, their stock should shoot up a lot. Okay, flexible architecture expanding to drive strong margins. So we talked about that earlier. Gross profit. So increasing gross profit, profit margins, EBITDA. I'll do a comparison a little bit later with the other LiDAR companies. Simplified digital architecture placing projected to reach 60% by 2025. Material improvements in scale, fully funded through this transaction. We expect to be EBITDA positive by 2023. Proceeds projected to cover operations and growth investments. So they're saying that they probably don't need to do any raising or whatnot until not even like ever, I guess, because they're expected to become positive EBITDA and cash flow in 2023. Okay, transaction overview. So again, 200 million in the trusts from the SPAC, 100 million from the PIPE. 35 million expected for the cost of the transaction. So that leaves about 265 million to the balance sheet. And like I said earlier, they have about 14 million in the Ouster's balance sheet. So 15 or 14 plus 265 is approximately 280 cash at the combined company. So the enterprise value, the equity value is 1.8 billion less the cash to get the enterprise value of 1.5 billion. So they're just comparing benchmarking with Velodyne, Avina, LiDAR, and Innovis. 143% combined growth rate for pretty in line. I mean, they're all pretty high. Gross margins pretty even, pretty in line. EBITDA margin is pretty in line with others. I guess projections as well. So here's the valuation part that's interesting. I'll show you a little bit like what I did later. Do this a little bit. I'll do this after, but let's finish this. 1.9 times 2024 EV to revenue. Of course, this changed a little bit. I'll show you the updated numbers. So you can see it's cheap compared to the other LiDAR companies. And here it's just saying again, they're saying that, okay, if you're based on the projections, this should be a 10.3 or 8.3 to 10.3 billion valuation. They discount it by 20%. And it should still be approximately 4.8 to 6 million in today's value. But they're transacting at 1.6 billion, which sounds very, very cheap. Proceeds expected to help drive rapid scale. Build out worldwide. This is what they're using their proceeds for. Build out worldwide sales and marketing effort, increase software development investment, and accelerate product roadmap. Okay, so let's look at the valuation. Okay, so I believe I've updated these already. Yeah. Okay, let's look at this. Okay, so $14 is what they're okay, so I'll tell you what it is. $14, they're outstanding shares. This is the market cap, but sometimes it's better to look at enterprise value because then you strip out the cash and debt and to really what the company is, excluding those. So enterprise value right now for CLA is about 2.3 billion. I did this for Velodyne, Luminar, Innovis, and Aviva. Stripping out the cash, this is their share price. Let's just check a couple of times. Just 22.87. Yeah, so it looks like I updated. 32.36. Yeah. Okay, so I went through all their investor presentation. I took out their net cash, net debt. I got their sales from their investor presentation. These are all again projections. So depends how much you believe in these projections. They could be very far off. They could be in line, and who knows what's conservative and what's aggressive. But I just kind of these are just information I got, and I just kind of plugged it in. So then the EV to revenue ratios, which is pretty much taking their enterprise value divided by their sales. Based on these valuation, you can see looking at 2024, because you got to go a little bit further. If you look closer, it's hard to value because these are just going so fast. So you won't see the valuation gets a lot cheaper as they continue to grow. So that's why you see very high multiples in the beginning. But let's look at the 2024 because Velodyne didn't have 2025 projections. But looking at 2024 EV to sales, Ouster CLA is trading significantly cheaper than Velodyne, which is their most similar business. Perhaps Velodyne today is bigger because they have a lot of revenues, but they're only growing at 65%, which is still pretty good to be honest. And I used to be a Valuation shareholder, pre merger, but I sold it right after they merged. I sold it around this price actually, I think. So quite interesting. So even 2024 sales, they're trading a lot cheaper. Compared to these other three, they're more of the automotive LiDAR technology that trades very expensive, and the most expensive Linamar. So they're the ones that are actually working with Volkswagen. So there's a lot of excitement with this. And the CEO is a brilliant guy. He started the company when he was 16, supported by Peter Thiel as well. So maybe it does command a higher valuation, but you're looking at like 10, not 10 times, but like 9 times the valuation on 2024 estimated revenue. So like you look at it, so Linamar expects to make revenue of 418 million in 2024, trading at 10 billion, but this company is expected to make or have revenues of 818 million, and it's only trading at it's more than double of its price, but it's like a fifth of its valuation. I mean, a fifth of its enterprise value. So it's not fifth, like a quarter of the valuation. So it trades a lot cheaper. So so that's why I'm really excited when I looked at these numbers. I don't know how true. So you could commend Velodyne maybe and Linamar are more well known, or they're the bigger. I don't even know how you say bigger because they pretty much have the same expected sales next year. Velodyne maybe, but again it's growing at 65%. So, and if you look at 2025, even though Velodyne didn't have it, but you look at 2025, it's still trading the cheapest amongst the group, significantly. And even looking at enterprise value, so I pulled these from their investor presentation. So Velodyne is expected to be EBITDA positive in 2022. And then Ouster is expected to be positive EBITDA and cash flow in 2023. And that is before Linamar, Innovis, and Avina, which is expected to be EBITDA positive in 2024. Okay, so, and even if you look at, let's say they're all cash flow positive, or not, EBITDA positive in 2024. So looking at the price to, or EV to EBITDA ratio, Ouster is trading a significantly cheaper compared to even the next person, which is Velodyne. If you look at 2025, again, it's significantly cheaper than even the next one at Aviva. So I'm just kind of playing with numbers. Oh yeah, this is the compound annual growth rate. So it has a still pretty good, so this is annual growth rate between 2021 to 2025. So I didn't include 2020 just because I didn't want too many lines and numbers and whatnot. So I just did 5 years, 2021 to 2025. The compound annual growth rate is 161%, which is pretty incredible. I mean, Aviva and Innovis have pretty similar, or even better, compound annual growth rate. With Linamar, is pretty. I mean, 138%, no one's gonna complain, or even 65%, no one's gonna complain. So there is definitely a growing demand for these LiDAR companies, I think, as we transition into autonomous and not just that, robotics and AI and industrial, and so and even I think these all gone up a lot. It's also because Apple's come out with the cars and supposedly use LiDAR technology. So I'm just saying, okay, well, let's say if Ouster trades the same valuation as Velodyne at $5.35, I'm not saying $5.35, 5.35 EV to sales ratio, the stock should trade at $26, which is representing an 89% upside. And if I just use the same valuation as Innovis at 2.77, let me just make sure I'm picking the right numbers. Yeah, 2.77, it should trade at $26.57. So if Ouster is trading same valuation, they should be at $26 stock. And that's looking at price to sales or EV to sales. But looking at EV to EBITDA, if Ouster is trading at the same valuation as Velodyne in 2024, it should trade at $37. And if I took the second closest, so actually for EBITDA or EV to EBITDA, Avina is actually cheaper than Innovis, so I took the second closest one, I'm saying. So that is suggesting if she trade the same multiple, it should trade at $28. So it's suggesting 105% upside. So do I expect it to be $26 or $30, $37 or $30? Probably not. I mean, what's reasonable? I mean, even though, let's change the price of this, okay? I'm changing this to $20, okay? Even if this goes to $20, the share price of Ouster, it's still trading cheaper than everyone else, right? Yeah, like every ratio still trades cheaper. So I just don't really know why. I mean, maybe you leave me in the comments below why Ouster is trading so cheap. Maybe because they're not really known to the public yet. I mean, this is the most latest LiDAR technology company that came out with the announcement, the merger. I think maybe it could be like an IPV where there was like no noise. Like if you look at IPV, there was I think they announced it like November, early November. So like there was nothing happened for the longest time. And then I just shot up. I mean, now it's coming back down quite a lot, to 15 from 18. Like I don't know where it's gonna go, but let's say if it's $20, I mean I think if it trades reasonable, so something has to happen. If it all should trade the same, I agree that maybe the bigger companies should trade are more excited or more popular names should trade at maybe a slightly premium, but this is a significant premium. And something has to happen. Either CLA, if they were to trade a similar valuation, even like a little bit higher, either CLA has to go up, or the other has to come down. Because just right now the valuation is just so different. So that's why I'm pretty excited on this one. I started a position on it. I'm building out my position. I hope it doesn't fly like butterfly networks, but I just bought some today. So if this continues to go down to $13, $12, and again, this cannot go under $10 because this is a SPAC and the company, the money, like this is a SPAC, so the company has like they can redeem the shares for $10, so it won't go lower than $10. So the closer to $10, the lesser risk you would be taking, and that's and compared to all right now, that's the one with the least risk in my opinion of downside in the near term. I guess, of course, because after they merge, it could go under $10. So from a valuation perspective, like I mean, I think this is incredibly cheap compared to the others. And even if let's say if it's $20. Well, how much upside would it be? 42%. If it trades at $20. I mean, I don't know if I'll get to $20, and maybe there won't be any excitement. Maybe people won't recognize it. But if I were to buy, if I had to choose between these 5 companies, CLA would be the one I would invest in today, as opposed to the others. I also like their diversity in their product mix and their customer base, good growth rates, strong balance sheet. It just seems like their investor presentation just looks really good, and the valuation looks really good. And another thing to just play around with numbers. So let's say this is this is as if they were trading on the transaction value. So all these SPACs usually at $10. Okay. They're still trading at the cheapest, like half of Aviva or 78% cheaper than Aviva, cheaper than Innovis at $10. So I'm not sure why the price is so low. Especially like these are pretty good numbers. Like 34 million is the second highest in 2021, and it's still the second highest in 2022. Same 2023, but in 2024 it will be the highest expected projected revenue. And look, 1.5 billion in revenues in 2025. That's like almost double of Aviva or Lunamar. And the valuation is just like a fraction of it. So for those reasons, I really like Ouster right now. I don't know where it's gonna go. These are very speculative, so again, these are just my opinion. Before you make any decision to buy or invest, I suggest to talk to your financial advisor. I just give you numbers, what I've taken from the investor presentation, and making sense of it and looking at the valuation compared to the others. See if there's any comments. Sorry, I was just so excited talking about this one. Okay, thanks. Is the valuation $14 still cheap? I'm gonna go back. Bought some CLA last week. Hey DJ, still holding it. I think Butterfly Network is too expensive for $20. I do think so too. I think it's reasonable. I mean, I wouldn't say it's outrageous at $20. Let me see. Butterfly, yeah. Butterfly's LGVW. Yeah, $20, like I talked about earlier. DJ, yeah, I think it's reasonable. I mean, I wouldn't be buying the $20. I'm not happy with what I have, but I wish I had a bigger position. Who knew that ARK was gonna invest in the $15 and $14 range? I thought they were gonna buy it in the, I think they did buy in the 13 and 14s, and that's why it shot up and came back down. I bought some, and I was planned to add, but it just shot up after for Butterfly Networks. Please make a video on your portfolio. I did have previously. I did have a video on my top 7 holdings. It has changed. I'll think about creating another video just to go over my, again, maybe 7 or 5 or whatever number of top holdings I have. I actually don't even know if it includes any SPACs. I don't know. I'll see. I'll think about that one. Is the valuation at $14 still cheap? I'm assuming you're talking about CLA. I just finished talking about that. To me, yeah, $14 for 1.5 billion revenue in 2025. You're trading 1.4 times 2025 sales enterprise value. That's cheap compared to the others. It's cheap compared to the others. Thanks DJ for liking my spreadsheet comparison. And yeah, I like doing that. It just kind of breaks it down, and I know what I'm looking at, and just kind of helps me compare each of the company. They're on the LiDAR space, except like these 3 are more of automotive, and these 2 are more of the general. So that's why I don't know why it trades so much cheaper than the others. Yeah, who knows? Who knows? Maybe it'll stay that way. And things that are expensive can always be expensive. I think Shopify is expensive and continues to be expensive. Zoom, I think it's expensive. It continues to be expensive. Tesla is always expensive on metrics, but look at where Tesla is. I like Tesla. Don't get me wrong. I actually own shares of Tesla, but it's expensive, and maybe it's always going to trade at a discount. I mean, I don't know what's going to happen, but like if you ask me to choose between these 4 or 5, I'd choose Ulster, CLA. At some point, do you think LiDARs will be a commodity, or do you think that's really far out on the horizon? I don't know. That's too far. I'm not trying to predict that, but I do think LiDAR is a technology that will be increasingly needed for various reasons in the different industries, and not just automotive, which we know that there is a huge need for that into the future for autonomous driving, etc. But industrials need it, robotics, smart cities, smart infrastructure needs it. I think it's just a industry that will continue to grow. Good job buying Haley Hilo, buying Longview at $14. I bought it around the 14s and 15s. Too bad. I wish I'd bought more now, but then hindsight's always 2020, right? I haven't finished building my position yet, but I'm glad I have some. Not as much as I wanted. NGA has done well recently. I talked about it. I got in the warrants too. But for some reason, this doesn't really show. But I mean, it's been dropping recently, but hasn't done bad. It is. Okay, I think that's it. If you guys haven't had the chance yet, please do like my video. I do spend some time putting this together and going over the investor presentation beforehand and just kind of thinking about things and sharing with you guys my opinion. If you guys appreciate it, please do subscribe and click the bell notification so you'll stay up to date with my videos. I'll be trying. I don't know if I'll be doing a live show every week. I'll try. If I have something good to talk about, like today, like with CLA, I'll definitely create one. I think this is a great opportunity. Having said that, invest at your own risk. I'm just sharing with you my opinion and what I did. I do hold some shares of CLA. I'm still building out my position. If it goes into the 13s and 12s, I'm buying more. Maybe not 13s, maybe 1350s, we'll see. But I like to build up of a bigger position. It's not, even though when I say bigger, it's not that big of my portfolio. These are more speculative investments of my portfolio. So I own some core assets or core investments, and then I have some speculative portion of my portfolio, and I just kind of play around and get into these SPACs or these risky, I guess these are more interesting to people, I guess. Yeah. Alright, which SPACs without DA? Which SPACs without DA do you have? What do you mean? I'm not sure what you mean. Which SPACs without DA do you have? Hallie, hello. Forum Merger 3. That one seems interesting. I looked into that one. I had at the same time. I think it went public, or the announcement was the same day with GIK. But I haven't looked. I briefly looked at it, but haven't looked too much into that one. Okay, I think I'll leave it at that. Thanks for joining. Again, if you haven't had the chance yet, please do like my video and subscribe. And I will try to be back next week. M747, thanks for joining. Yes, NGA is up. I like that one. I'm thinking about trimming my position in that one. Hey Raymond. Yeah, so I'm thinking about trimming NGA actually on the warrant side because it's gone up a lot on the warrants. I do sometimes buy a little bit of warrants depending on what price they trade. Sometimes I own NGA, I own shares and warrants, but sometimes it depends on which one I think is cheaper, then I would buy warrants or whatnot. Those more risky. So if you're not an investor, please probably shouldn't invest in warrants. You have to understand the riskiness of warrants because the loss or gain can be amplified, and so it could go the other way. Oh, the pre-target. Okay, I see what you mean. Like DA as in pre-target. I actually own a few. PSTH, Bill Ackman was one I own. I like that one. IPOF I actually own too. I like that one too. I believe you're familiar with C Limited. Yeah, I like C Limited. GH, hey GH. I guess I'm just answering questions now. Okay, I'll spend a little bit more time answering questions. I believe you are familiar with C Limited. I think you own their stock. Yes, I do. What do you think of BTWN? There's a rumor that they are trying to merge with Tokupia. I haven't looked into that one. Is that another SPAC? There's way too many SPACs to follow, to be honest. So I'm not very familiar with that one. Perhaps maybe one I will talk about next week. But comment below in the video if you have a video of stocks or companies you want me to cover in the future. Raymond asked me, what does trimming mean? Trimming means like stock goes up a lot, and then you want to cut back on your positions. So for example, like I bought a stock for $100. Let's say that was my, let's say I have two stocks and I have, let's say I have two stocks and like 50% of it is in this one stock, and it gone up, I don't know, 100% from $100 to $200. So let's say I have 100 shares. Because now it's gone up double, and meanwhile, let's say my other one didn't go up at all, I want to kind of cut back on the risk of it going down, because if stock goes higher, there's more risky that it would come down. So I trim a position means like I just sell some of the position, but I'm still hanging on to some. That's what trimming it really means. Yeah, I like C Limited. If you haven't had the chance, you could watch my video on C Limited. I talked about it. I don't think it's one of my largest position anymore. I didn't trim, and that's just because either grew or I added to other positions that I like more. C Limit is always traded very expensive, but their growth rate is incredible. So it's really a combination of how comfortable I am with evaluation and how much of that do I want as a part of my portfolio. Okay, I think that's it. Again, if you have any companies you would like me to cover in the future, please put in the comments below. If you haven't had a chance yet, please do subscribe and like the video. It really helps with the algorithm. Okay, thanks guys. And until then, see you guys possibly next week. Eric, HWS, I talked about it at the beginning of the video, so just check it out. Okay, thanks guys. Bye. See you then. Happy investing, guys.